Hello, everyone. This is yet another episode of Off the Record with your host Aram Melkoumov. I'm here. I'm here today with Stephen Forte, managing partner at Fresco Capital. He was chief strategy officer at Telerik, a leading vendor of developer and team productivity tools, which got acquired in 2014. He's a little bit about Stephen. He's an avid mountain climber and leads an annual charity fundraising trek in the Mount Everest region. Stephen, it's great to have you on our show today. Thank you for joining.
Thank you for having me. It's great to be on the show.
Awesome. First question I was just curious. Have you, since you do this fundraising trek to Mount Everest, have you actually been to Everest before or climbed it?
I warned you not to ask this question. I said it would suck up all our time, so I'll try to be brief. But I've actually never climbed Mount Everest to the top. I've been on expeditions that did go to the top. It's a longer story, and the short version is it takes 2 months. And when I was younger and less risk averse, I didn't have 2 months because I was hustling. And
All right.
now that I'm in the second half of my career, and I could probably afford to take 2 months off. It's more complicated. I have a wife, I have a kid, I have a business I run. It's a lot more difficult. And probably a little as you get older, you probably get a little bit more risk averse. I have been to Mount Everest Base Camp probably about a dozen times on the charity treks. So it's been fascinating watching people go up the mountain and helping raise money for the charities, which is a local school, which is what we raise the money for.
Awesome. Is it on the docket for you in the future then at some point or?
And to be honest, I don't think so. I think
Okay.
I have, as I said, it's a longer conversation about
Yeah.
helping transform the local economy in the Mount Everest region, the Sherpas,
Right.
bringing them ownership in some of the indigenous people there, giving them more ownership in the trekking. So instead of trying to dissuade people from trekking and tourism, that is truly, a gold mine for the locals.
Yeah.
But the locals aren't really getting that gold at the moment. It's wealthy businessmen and women in Delhi and Kathmandu that are getting that money. So I'm looking to get them a higher percentage of that and have some ideas. So I feel like I'm going to spend more time as I advance that idea. And then of course, as my daughter, who's only 6, as she starts to grow up, I want to start bringing her to the mountains I've climbed. And you don't start with Mount Everest. You start with like McKinley and Kilimanjaro and things like that, or Mount Rainier and things like that. So
Right.
yeah, so.
Cool. Well, that's an amazing thing that you're doing with the fundraiser though. So thank you
Thank
for
you.
doing that.
Um,
Um, all right. First questions I have to maybe kick it off is you've had an impressive 5 exits to date, all with different businesses. As a founder, through your journey or through experiences you've been through, what do you need to prepare when you go through an exit?
I think it's your expectations. So in essence, I had a friend when they signed a letter of intent. He was going out and buying all new furniture for his new house, and his wife was buying deck furniture for the deck of their new house. The new house they don't have yet. And you really have to have the expectations of a couple of things. One is the deal itself as you negotiate the deal. The second is what the payout structure is going to look like. If there's an earnout, if it's cash, if it's escrow, And then third is just like morality, right? Like money really shouldn't change you all that much. Like, what are you going to do after this exit, right? Like, is it a big exit? Is it a small exit? A lot of friends ask me, why do you still work? I'm like, well, why wouldn't I?
Yeah.
Right. That type of thing. So that's definitely one of the things that you need to prepare yourself. There's some legal things and stuff, and we can drill into those if you want, that you should prepare yourself for as well as a founder. Just real briefly before you maybe even ask some of them, I think it's important to bring up. I think it's critical for founders to have their legal due diligence stuff ready before an acquirer even comes. And what that really means is getting all your ducks in a row. That's a very American term, but maybe to explain it more, is just making sure all your legal stuff is up to speed before you have someone knocking on your door to buy the company. So making sure you have your regular board meetings with the minutes, that are, logged with your lawyer, right? I know it's a drag, but you get that done. Make sure all your employees have their IP confidentiality agreement signed. Make sure all your vendors have it signed. Make sure all your cap tables in order, like all that stuff, which, it's going to cost you some money and time. Just get it done. And if you do it along the way, as opposed to like this bum rush
Mhm.
before, the exit will be a lot less stressful, the negotiations, and it will go faster, and the due diligence will be a lot easier.
Okay. Um, so yeah, that was going to be one of my questions I was going to ask about the legal side, but um, as a founder, when you obviously invest in a lot of founders, a lot of businesses, but like if a founder was to come to you now asking for advice in terms of when to exit their business, what would you want to tell them?
Well, it's interesting because as someone who's been on this, well, this way, my perspective has changed, probably in the last 10 years. Partly, as you mentioned, I had 5 exits. Most of those exits were to large publicly traded companies. So it's pretty standard M&A, Google bought one company, a company called Progress, a big publicly traded company bought another company up in Canada called Wanted, traded on the Toronto Stock Exchange, bought another one. So, going through, the large, right, bigger tech company buying smaller tech company, it's pretty straightforward. But then I've also been through like a private equity roll up in one of these exits and then one acqui-hire. So like, you kind of figure out how, how the mechanics work. But then of course, as a VC, I mean, I've lost track now. Like, we've probably, I mean, I really should know this, the exact number, but let's call it about 15 exits, over the last 7 years or 6 years at Fresco, and some ranging from IPO to M&A buyout, the same gamut of things. So the real true answer to that, after all that perspective of both being an entrepreneur who sold his business as well as a VC who's invested in a business and then worked with the entrepreneurs, is when it's right for the business. And I know that's a little of a generic answer, and I know it's a little bit of a maybe a cop out. People might think, if you're listening, I apologize if you think it's a bit of a cop out, but but it happens to be true. And one of the businesses I had sold, it was actually the second exit I went through. It was absolutely the right time for the business, and the partner buying was the right partner. The dollars weren't amazing; it was okay, right? And my business partner, who had a little bit more than me, I mean, it was about a 60-40 split, and then I mean of the equity that was left over, and then we had some investors, but in essence, it was our decision. And at first he was a little hesitant because the numbers weren't amazing, and there was a lot of upside potentially with earnouts and things like that. Mm-hmm. And I just kind of appealed to it. I said, this is the right reason, this is the right move for the business, even if it's not the right move for us personally. And, then it got a little emotional because, I was in my 20s and he was in his 50s, and he's like, well, you could just go get a tech job anywhere. Like, you can go work at like this new startup I heard of called Facebook. You can just go get, you're young, you're a techie, you have skills. He goes, I'm in my 50s. Like, I can go get another boring CEO job, right? But I'm not really going to probably do another startup in my late 50s. And I said to him, but like, as I said, the money wasn't amazing. So I'm like, I could go buy a nice car and that, but I go like, I still have to work for the next 40 years, right? Like, so like I'm, if I really wanted to go for the bigger money, I would say, let's hold. But I go, it might not be the right move for the business, even though it's maybe not the best for us personally. So ironically, I had that conversation in my 20s at my second startup as a founder. But that position has hardened along the way, especially as a venture capitalist, right? Especially going in as a VC and seeing the, these exits coming. And sometimes you see a company sell at the wrong time, and no one's really happy, including the buyer, and as well as people maybe selling at the exact time, and everyone's kind of happy: the buyer, the seller, the investors, everyone else, right?
Yeah. That's interesting. And if I'm not mistaken, you've also gone through kind of 2 different acquisition style exits, right? Through your journey. Along the way, or what are the things that you could maybe share to the founders who are going to be listening around how do you not sell yourself too low when that acquisition exit happens in your business?
You mean the exits that are necessarily just buying up the team, right?
Yeah.
Yeah. So so you're right. I think, you're probably, if I remember our conversation, but I mean, I know what they are, is, I had 2, just to, the viewers don't know, is I had 2 exits that were either, one was pre-revenue company and the other one was pretty low, small revenue. And they were bought up front. And the biggest piece of advice, actually I have 2 pieces of advice that would go there. The first is, when you're selling the company and you want to make sure you sell stuff, like, whether you're too high or too low, is always look at the value of your company as a function of the value that you're adding to the company that's buying you. Because if you're selling a pre-revenue company or just a low revenue, like maybe 2-3 million in ARR or lower, or even if it's anything under 10 is still probably considered small for some of the numbers that we want, valuations. stop trying to run like a cost benefit analysis and a discounted cash flow analysis and, you know, a PE ratio analysis, right? What you really want to do is what type of problem are you solving for the buying company? You know, for example, if I had a friend who had like a business that was a steady $5 million business, it was profitable, and he was going to go sell his company to a company that I was familiar with. And I actually knew their CTO, and coincidentally was having dinner with him the other night. So I was kind of like now in the middle as a broker, and I had to be careful because like both were friends, right? One was publicly traded, right? You know, so I wasn't at the time. At points in my career, I had been registered with the SEC, but I wasn't at the time. So I had to be super careful. But I kind of got from the buying company that they were trying to, you know, they had like a $20 million hole that they were trying to fill with this acquisition. Or maybe it was actually, I'm sorry, they had a $100 million hole that they were trying to fill with that acquisition. And so I went to my friend, I'm like, well, he keeps saying like, well, they'll buy me a 1x revenue, 2x revenue. I go, forget that. I go, you're solving a $100 million problem, right? Like you may have to pay for it as an earnout over 3 or 4 years, but in essence, understand the problem that you're solving for the buyer, right? You know, so of course, the buyer, there's going to have accountants and lawyers and CFOs, and they're going to go beat you, or worse, MBAs. Don't get me wrong, I have an MBA, so I can mock MBAs. But the MBAs are going to come in and start running DCFs, discounted cash flows, and saying that you're worth $2 million, or they're going to come up with some really insulting number. And all you do is just keep coming back, fine. You have to really be firm, like, I'm willing to walk, right? And that's the other thing. The other thing is you have to truly be committed to the deal and the vision. So it's not just like, oh, I built my business, I'm out, I'm gonna go buy the Ferrari, right? It's more like, no, I wanna go extend this vision, right? And I wanna extend this vision at the new company. So you have to choose the right partner that's gonna bring you the resources, the brand, and the talent, right? That's going to help you build your vision, take it to the next level. And you have to truly commit to that earnout. That's most likely in a scenario like that, it's going to be an earnout where you have like, if you're not familiar with the earnout, it's typically like, if you sell your business for $10 million, they might give you like $1 million in cash at the close. And it's never all in cash at the close. It's always dripped down over like 2 years. There's a cash, there's an indemnity, and then a holdback, right? So there's usually 3 payments over the course of 12 to 18 months. But you'll get this $1 million cash payout in the first 18 months. And then over the next 3 years, you're going to get, you know, there's $9 million left. It'd be $3 million of company stock over the next 3 years if you meet certain metrics and goals. That's called an earnout. And I find that that's actually quite aligned because it's cheap for the buyer. Because if you add the value that you say you're going to add, you will earn that earnout, and everyone's going to be happy. Meaning you will be adding money, and then you could retire, so to speak, or whatever it is, or leave the business and go do your next startup, right? You know, so ultimately when you're selling yourself in one of these acqui-hires, is you have to find the right partner, be true to the vision, and keep laser beam focused on the value that you're adding, as opposed to like just dollar, you know, like what the company is worth as a debt to equity ratio or discounted cash flow, like whatever it is, type of a thing.
Stephen, on that, something you mentioned, how do you determine what is that hole that you can fill within that company? So in this specific example, you said that the buying company had $100 million hole that they need to fill, but this company that was potentially, you know, going through that acquisition, you know, they were being valued at like 1 or 2 million, but the value that they could bring to that company is a lot higher. As like the company that is being sold, as the founder in that situation, how do you determine how big of a hole you're going to fill for that company in terms of the value?
Well,
like,
it should be
they'll
obvious.
Never share that with you, right?
Well, hold on a second. First of all, it should be obvious, right? You know, so I mean, as of today, Twitter is not buying Pinterest. Whenever the viewers view this, maybe the deal is super dead, or maybe it comes back. But Twitter, you know, Pinterest is obviously solving a problem for Twitter, which would be e-commerce, right? And vice versa, the synergy between the two, right? So ultimately, it should be obvious, right? Like when you look at some of these. But if it's not obvious, I actually say you can ask them, right? And then multiply whatever they say by 2, because they're not going to. You're right. They're going to be a little shy about it. But like, you know, people like to talk. And honestly, the way you really negotiate these deals is, I know with COVID it's hard, but like in a casual environment, you very, very rare are you like in a boardroom, like in the movie, sweating, and like an offer comes in, they leave the room, they come back. No, it takes like 2 months of phone calls and coffee shop meetings and you know, you meet up at a conference if you're not in the same city, you know, like, and I mean, honestly, one of my acquisitions started with grabbing a beer with them at a conference, and they said, "Hey, what would it take for us to acquire you?" Almost as a joke. And like my partner, unfortunately, threw out a number, and like that was their first bid. Like, dude, I was like grabbing him, like, dude, I kick you the table. Like, don't give a number, just say like $1 billion then, right? Because then now you've anchored, right? But ultimately, yeah, you would you would then, and then here's the weird piece of advice, or the piece of advice that you probably never considered is, listen, we're startup CEOs, startup founders, startup CTOs. We're experts in our domains. We're not experts in M&A, right? I learned that people think I'm an expert in M&A. No, I just asked the experts and took their advice, right? So when I was selling that IQ Hire, I had a really good friend. She and I were running a marathon together. So we were training 2 or 3 days a week. And long story short is, I lived in New York, and she worked at a top tier M&A analyst fund, right? And every single M&A deal that ever happens, like they write up the brief, right? And then they sell it to hedge funds, this, that, the other thing. So I just asked her. I asked an M&A expert, right? And she went in, she dove into their stock, gave me numbers, and I just like copy and pasted some things out of her email onto my emails back to them in the negotiation, right? Like, oh yeah, you add our EBITDA to your EBITDA, and it's going to add to your stock price this and that, and like, you can see pretty quickly how fast the conversation turned, right? So ultimately, someone's going to know. If you don't get it from them directly, and if it's not obvious from just the market moves, an M&A expert can tell you, because most likely it's going to be a bigger company that's either publicly traded. I mean, if someone's can afford to buy you, someone's done some analysis on that company.
So having close friends who are familiar with M&As is a handy
you can find
to
them.
pull from. Yeah.
Yeah, you can find them, whether it's, if you went through an accelerator, someone will know someone, right? Or you could, or just pay for it. If it's big enough deal, just go pay a little bit to have someone help you out. Like there are definitely, advisories out there, and they're not as expensive as you think. And then they'll pitch you on representing you. And if this is the first time you're doing it, that's not necessarily a bad idea. They could squeeze extra. They'll pay for themselves by squeezing a little extra value out. Yeah.
Stephen, out of the 5 exits that you had, which one do you still come back to kind of person when you reflect in terms of the biggest lesson learned through the process?
Yeah, and this is the one where folks, this is the one that was the largest on the numbers wise. But at Telerik, which was the last one before we started Fresco Capital, we sold for, all in like, about $300 million and change or whatever, however, there was a little bit of stock involved. So like the stock went up later. It was like $250 million in cash. And then there was some RSUs involved and stuff. However, I viewed us as a competitor to Atlassian, and I viewed us as a competitor to Atlassian because like, that's what we talked about in management meetings a lot. It's not like I'm sitting there alone by myself with my peers, right? And Atlassian went public for $6 billion, right? So I feel like I left $5.5 billion on the table, right? Like even though there's this amazing exit, it was like 90-something% cash, upfront cash, right? Like it was, like no one really lost their job up front. I didn't go into the new company, but most people, everyone who really wanted to go to the new company went to the new company, right? That kind of thing. There was a decent amount of synergy, so it was a good enough deal. But I feel like it's one of those examples of we can go get that big number, or if we would have taken maybe a VC round. And in fairness to us at the time, the VC dollars wasn't, this was 10 years ago, wasn't as flowing as it was flowing today. You weren't able to get these higher valuations. But I do feel like, if we had taken another VC round and built other products, expanded things, we easily could have went out and, today, especially today's market, right? When I look back at that, like, could have, been, 5 billion, like just like Atlassian. Yeah. So a lesson learned. Don't get me wrong. Everyone was happy with the outcome. Our Series A VC was happy with the outcome. It was easy 10x for them, right? Which is what they're going for. So, ultimately, when it's all said and done, it was a great deal. But I keep coming back to that one, is just because it's a great deal doesn't mean that, it doesn't mean you couldn't have done better, right? But if you have to have a risk tolerance, right? Because this company we're 10 years in almost, or something close to 10 years in at the time. Maybe not quite 10, but we were 10 years. Actually, no, yeah, we were 10 years in at the time, right? So on the flip side, a new deal, that would have required more risk, more dilution, more board member, so there's a cost, right? To get to that Atlassian level, right? So like it really is a time value of money equation in your head. Like, do you take the slightly slower all cash offer now or roll the dice, right?
Yeah.
Having had 4 exits under my belt at the time, I was like, yeah, let's roll the dice, right? But a lot of other people, it's their first rodeo, right? So
Yeah, they wanted to cash out. No, that makes
yeah.
sense. Interesting. No, thanks for sharing that. Next question I have is going. It's your story from going from being a founder to a VC. So, from all the people I've spoken to, and we talked about it as well, but everybody seems that as like a sign of success. I wanted to ask, why do you think that is?
I think because everyone feels like the grass is greener on the other side. People think VCs have the best job in the world, and VCs think founders have the best job in the world. Yeah, I don't know, to be honest. When we can talk about, I kind of fell into it, into the VC, partly because I was angel investing. And then when Telerik was sold, it seemed like a good idea. But for me, Fresco was also a startup. So I felt like my 6th startup, right? Like, we built the VC fund from scratch. But ultimately I feel you're right that people view it as like this. I've successfully, like crossed some chasm. I've graduated from founder to VC, and I think you graduate from founder to founder of the next big thing is more of a success story, right? Than it is than it is going into the VC world. Because don't get me wrong, like the VC space is exciting, but it's measured in 10-year cycles. So that means if you want to innovate in your fund structure, you're not going to get feedback potentially for 10 years, right? So it's a very different universe than the pace in the structure you're working at with a startup. And it's also a lot harder, believe it or not. And maybe that's the good part, maybe when you maybe want to leave to become the founder, because it is a new challenge. And that's actually what drew me to it, right? Because I'm like, it sounds a little, maybe a bit of hubris or whatever, probably more naivety, is I kind of felt that at this stage of my life, going into another startup is what's expected. And I felt like, let me do something that's a bigger challenge, right? Because it's definitely a way bigger challenge raising money for a 10-year fund than it is for a startup, right? It's just, it's institutional capital is so much different than startup capital from VCs, right? So it's,
I want to ask you about how do you, I think I know how people actually become VCs, but I want to ask you maybe another question is, there's a lot of, as you said, the grass is greener being a VC, but what sucks about it, I guess is my question, because I'm curious if success looks like of founders going and becoming VCs, because that's like the next thing that they do. Should we maybe be discouraging CEOs going down the VC route and having more CEOs creating companies? Let's talk about that. Do you think that that could be an idea, or like what sucks about being a VC, I guess?
Yeah, I actually do try to talk founders out of becoming a VC, and I don't know if I would frame it as what sucks as being a VC. I'm gonna just say what is because if it sucked, I wouldn't do it, right? But what is far less fun and desirable than being in a startup is the following and then there's something you have to unlearn, right? So the first is an operator, right? So if you're an operator and you're used to doing, let's say you're a growth marketer. I just was talking to a buddy of mine. He's a hotshot growth marketer at, you name a fast growing startup, he's probably worked there over the last 10 years, right? Boom, boom, boom. And I was just chatting with him right before I hopped on this call. And if he went and became a VC, he's gonna go from being a growth marketer working in a high bandwidth environment with fast results, with an amazing team that's always growing, to working at a still amazing but stagnant team that's not growing. You add members at VC every fund cycle, which is about every 3 years. That is a slower pace, and you're talking about growth marketing as opposed to doing growth marketing, right? So if you're ready for that, if you're ready to become a teacher, to all your founders and all your staff, and if you're ready to, not be on this like rocket ship, right? That's growing super fast and there's no perks, right? Unless you work at Andreessen Horowitz, I'm sure. Unless you work at like one of 5 mega funds, there's no perks. You're not going to get the free lunches and the dogs to work and that kind of stuff either, right? It's just a very different style. I felt some days, especially as someone who writes software code, like I haven't written code now, in a zillion years, right? Like I feel like I'm doing something wrong. It was almost like the morphine drip was taken away. Like I feel like there's a little sense of withdrawal, right? So you go from being an operator to then reflecting and drawing on your lessons from your entrepreneurial environment to help others, which is a very big change. And if you're, I don't want to like disparage the young, but if you're 27, I'm sorry, I don't care who you are, you don't have the right experience. You just don't, right? I mean, I know there's a lot of 27-year-olds that are more successful at me at being a VC, but they're successful for other reasons, not because they're doing their 6 years of experience since they graduated university and bundling that up, as opposed to somebody who's got like 20 or 30 years of experience, right? That they bundle up. Something like a Sequoia that comes in as an operator after 30 years, right? Second is, as an operator, you have to then unlearn your kind of entrepreneurial skill set to become a successful VC. So in the first year as a VC, I sucked as a VC. And it didn't suck as a VC because like I didn't understand like buy low, sell high, because that's really what it means to be a VC, right? Buy low, sell high. Like, so there you go. There's a secret of being a VC, right? Go find a startup that's undervalued or at the right price and hold it until they IPO. Like that's the business model, right? So in essence, how come an operator like myself and other operators that I've talked to, why do we suck the first year or two at being a VC? Because we brought our entrepreneurial skill set to the evaluation process of the companies we wanted to invest in, right? So if you were pitching me XYZ company, I would eventually stop listening to you and start dreaming in my head, well, if I was CEO of this company, here's what I would do. And then I start like liking my ideas because I'm an operator. I can't turn it off, right? And my partners at Fresco hate this about me, right? Like, we have an audit right now. And like, I'm like, my operator engine jumped in like, well, we got to fix our back-end software for our accounting and our this and our KYC process, and we can automate it. And they're like, stop, right? Good operators can't turn that off, right? So I couldn't turn off my entrepreneurial, whatever you want to call it, in the head. And I was evaluating companies and biasing my decisions on what I thought the company would do, not necessarily what was coming out of the founder's mouth or was on his or her slide deck. Right? So, and then when they would go and execute their plan, as opposed to my plan, I would be slightly disappointed because in my head, I invested in the company because it was my vision of where the company would go, right? Every operator makes this mistake. Every hardcore entrepreneur makes this mistake when they turn into a VC, and they either quit or they have to unlearn it, right? So those are the two really things that like are very, very different, right? Like you're no longer the operator, right? And then it's hard to turn that operator off and become a teacher, right? Because that's what you're doing, right? And then your evaluation process is skewed because of precisely because of your entrepreneurial experience, right? So luckily, along the way, I had gotten an MBA and I've been involved in enough M&A. I was able to have enough pattern matching, because that's the reason I wasn't mocking the 27-year-olds. Is VC is a hits business. How do you, completely a hits business, right? Like it's, you invest in 30 companies, maybe 5 of them are going to make you the real money, right? So you're investing in hits. So you're no different than a Hollywood producer, right? Like you got to get the blockbuster movies, right? So as someone who's now approaching, midlife here, right? I have worked probably with, 2,000 startups in some capacity, either as an investor, as a mentor at my own startup, or partnered with those startups, like you name it. Like I have touched as a mentor, as an investor, or as as a company that's pitched me and I've turned them down, and then they keep me on their thing over the last 15, 20 years, right? Between angel investing, my entrepreneur, right? And now I have patterns. What worked, what didn't work. Now the successful VCs have more like 20,000, right? So I'm getting there. I'm working my way up, right? I'm 10% of the way there. So if you're 25, by definition, unless you started VC angel investing when you were 5, you're just not going to have that pattern recognition, and you're going to be biased because if you grew up in a 5-year bubble, like you graduated college in year 1 of bubble, and then you sell your company for $10 billion and you're way more successful than Steve, great. You only know that bubble, right? So again, like if you're 30 years old today, you've never seen an interest rate hike, right? Things like that, right? So the pattern recognition is also very important, and that's one of the reasons why I said if you're young and you have successfully exited your business, there's 2 reasons why you should just go do another one. One is you're probably going to be bored at a younger age being a VC, right? Because you're still going to want to be an operator with a high growth. But 2, and this is like the critical one, is you're going to be in this unfair advantage to go raise money because us VCs are biased. The number one thing we look for is like, is this entrepreneur going to make it? Do they have, like when SHIT hits the fan, right? Is this founder going to stick with the business? Is this founder going to kind of keep going? And if you've already done it, the answer is a glaring yes, right? It's such a marker. So you have this unfair advantage to raise money and capital, raise capital for your next startup, right? So by all means, that was a long answer. I hope it.
No, it's great. No, it's definitely answered it. My question is now, what are those? Maybe we could tie this with another question I have, but what are those patterns that you look for as a VC in the business or in that founder that you're investing in?
Well, we actually look at the patterns in both. So I can give you an example of one of each. The first pattern on the individuals is actually quite simple. And I have lots of questions that are thinly veiled designed to answer this type of questions. What is the ability of the founder that's now pitching me to react to changes in the market, changes to their assumptions if it's super early, or just whatever it is, and take that, synthesize it, and then if it's in the form of feedback, right, and then react to it. And sometimes that will cause some things like maybe drastic reactions when you hear the term pivot, which I'm not necessarily a fan of, right? But when you are a founder and you are going to absorb information, from that marketplace, how do you then react to it? Do you do it slow? Do you do it fast? Do you do it in a constructive way or in a haphazard way? Are you collaborative about it? Are you not collaborative about it, right? This is the single number one reason, which I think people not even realize when they look, because they don't look at the data, but this is the number one reason why VCs prefer to do more, maybe 2 to 3 founders as opposed to a solo founder. Because if you have 2 to 3 founders, by definition, you're going to go talk to that other founder when there's a crisis or when there's just question marks or sales slow, like whatever it is, right? That's the biggest one. How do the founders react to change or feedback or market conditions, right? And that's the biggest. And so the patterns are pretty obvious. The ones that do this in a constructive way, in a measured, collaborative, way and react to it as opposed to ignore it or fight it or make arbitrary decisions or unilateral decisions, right? Secondly, on the companies, so obviously the first thing everyone looks at is team, but that's the reason why, because these are the individuals, until DAOs take over the world, I say that sort of facetiously, it's always going to be people running these organizations. And let's face it, DAOs are still going to involve people because who's going to code these DAOs, right? But ultimately is, assuming we're not investing in some random DAO algorithm, that'd be fun, right? Let's just invest in algorithmic DAOs instead of teams anymore. So what are VCs going to say in 10 years, right? Like when you get that environment, because every VC says we invest in team first. So anyway, I digress. So when you look at the organization, you can tell I'm a little cynical. When you look at the organization, the biggest pattern is pretty straightforward, right? Is this the market that they are in? Is this a growing market, right? Because we've already determined that the team can, seize the opportunity, right? So that's table stakes, right? So now we're looking at the company itself. Is this a company that is in the right market, that's a growing, fast market that has lots of opportunity? And is their position in the market something that's going to be enable them for growth, right? Because you can have the best team in the world, and if you're selling, I don't know, alcohol in a Muslim country, I'm pretty sure you're having a pretty low growth environment, right? Like you're limited to the hotels and the embassies, right? Not much growth, right? Or you're in some other low growth environment, right? Where maybe regulatory hurdles, let's say, I use the example usually with tobacco in the United States, right? We keep making it harder and harder for people to smoke, thankfully, but at the same time it's not a growth industry, right? So, those are slightly contrived examples, right? But you kind of get the point. If the business is in a growing environment and it's positioned as well, right? So it's, and sometimes it's very hard to tell that, but the patterns that you see almost always follow those two things, right? The successful companies are going to be in these markets that are growing. So, it doesn't mean if you're in something that's low growth, you slap the term AI onto it, or you slap the term crypto onto it, or whatever, right? You have to truly be able to seize those type of opportunities. But you could also be in those markets. Remember the second criteria. You could be in one of these markets and not positioned, right, to take that growth.
Interesting. Okay. A couple more questions, Stephen. The next one I have, we talked about it briefly before, but I definitely wanted to bring it up. Do you feel that a lot of the founders or startups that exist right now, that they're being, how do I call this, over mentored. Um, and so, like, as a founder, how do you know it or feel it that it's happening to you?
I would say that the answer is yes, and you know we don't probably have the time to dive into why that's happening. I mean, I think it comes from a good place. Like people generally want help, and these early stage funds and early stage accelerators that provide that help. But founders definitely are being over mentored, and because you know, especially now in COVID, like rock solid mentors are like a LinkedIn search and a Zoom request away, right? Like so. So on one hand, I don't want to, what I'm about to say, maybe discourage a founder from seeking advice and mentorship. But at the same time is you don't need to talk to 10 people either. And you don't need to go build like these big advisory boards. So I do think that because the mentors are available, founders are, founders want to, talk to as many people as they can, which at the early stage is fine. You're still kind of doing your R&D and figuring it out. But ultimately is, there's definitely so much advice in there. And when you think you're being over mentored, it's a very simple task. If you feel like you've got to talk to like 5 people in order to make a decision, more than 4 or 5 people to make a decision, you probably have too many founders. Because the reality is, after you've talked to your co-founder, after you talk to maybe a member of your board or an investor, you probably only need to talk to 1 or 2 other people, right? You 1 or 2 domain experts, right? It's probably, or even something you're an expert in, it doesn't matter, right? You just need that second opinion or third opinion, right? I was going to say that, if you talk to 5 people and they give you 5 different pieces of advice, that's actually not a sign. That's actually okay. That means you have a very diverse group of people, and that's actually a feature, not a bug. However, it's your job not to, listen to pick one. It's your job to synthesize all 5 and understand the biases that all 5 of those people have, right? So I'm more of a tech guy than a marketing guy, let's say, right? So I always come at things from the tech angle. I've been an entrepreneur who's then turned VC. So you probably can assume some of my biases just from listening for the last half hour, right? So understand those biases when you talk to me, right? I'm upfront about them, right? But understand those biases when you talk to me, right? And then you're the expert for your business. So you have to synthesize, from all the people that took it and then take the right. So in Silicon Valley, we keep talking about diversity, diversity, not just with people, but also thought, right? So when we're trying to construct a lot of these boards and both advisory and governors, board of directors, we're looking for as much as we are looking for racial and gender, D&I inclusion, right? But we're also looking, D&I, the I actually is inclusion, right? So that's really DII, I guess I just said. But ultimately we're also looking for that diversity of thought, because that's what we're hoping we're going to get, as opposed to I have diverse person over here, diverse person over there. Someone says A, someone says B, and then we beat the other person up until the diverse person says B, right? And my argument is you get A and you get B, and then you compromise on C, which you never would have got to if you didn't have the diversity of thought, right? And that's what I'm encouraging the founders to do. If you're not doing that, it doesn't matter. If you could be over mentored, you could have 100 mentors, and it's not going to matter, right? So that's why you only need a handful of diverse mentors. At least 1 or 2 of them has to be a subject matter expert to what you're doing or the problem you're trying to solve.
So I was going to ask you, what's the right way to find a mentor, to help you? What should you look for? What should you give up if you have to give up something, or if anything at all? Do you look for diversity, or do you try to find maybe a couple people who have a similar type of knowledge that is maybe in your industry focus area, who are subject matter experts? Any perfect formula that you would recommend for how to find a great mentor?
Yeah, there's no perfect formula because there's so many options. If I gave you the perfect formula, then you might close down a very valid route, because there's just, there's websites, there's accelerators, there's your VCs and your angel investors. So there's so many routes to good mentors. So I feel like finding the perfect mentor, or finding a high quality mentor is relatively easy through your network, through that you're already connected to. And if you're not, you can do a search, right? Or cold outreach, like you find the people on LinkedIn. What's more critical is finding the right person and engaging with them at the right level. So you may have a public policy issue, right? Because your startup is starting to bump up against things in the public domain, regulatory, things like that. So you may only need to engage with a mentor that has the experience there for a couple hours over coffee. And then you just buy them something nice and send it to them for the advice, right? And then eventually you might, and part of their advice might be like, hire a securities lawyer or hire me even, right? Like whatever it is, right? But my point is, find the person you have a problem that you're trying to solve. Find the person who has some domain expertise in the problem you're trying to solve, and then contrast their advice versus the advice you're getting from the people without the domain expertise, because you want that diversity of thought and opinion. Or find more than one that might, one might be pro, one might be con, right? Like let's just say, oh, should I go into crypto? Go find a crypto, zealot, and go find a crypto critic, right? But both experts in crypto, and then synthesize their advice. But it's important that you engage with the mentors at the appropriate time, at the appropriate domain, and for the appropriate length. So you don't necessarily need to be like, oh, there's a great person. I saw Steve on this podcast. I want to sign him up as a mentor. And like, I'll usually say, okay, if it makes sense, if it hits my background, it hits my sweet spot, if the time commitment's okay. But you don't necessarily then like need to like say, okay, let's have a monthly call with Steve, right? Like then you just wind up giving me an update that you gave your board, and then you rather, better yet, instead of having that call, just send me your board notes, right? That kind of thing. Rather, a better way to engage with a mentor is probably more targeted. Like over the next 6 months, we're going to be going through growth style marketing. So I'm going to go engage with 2 or 3 growth mentors. And then after that 6-month period, you might keep one on board informally and the other 2, less so, right? And then, every 3 to 6 months, you're going to kind of cycle through a different folks, and there'll be some overlap, and not depending on the growth of the business. And then you said just from a level of compensation or thing is, it's ad hoc with each one of them, right? Like, some of them, if you want a deeper engagement, you can compensate them with some equity. There's tons of articles you can read about the fairness of doing it. I've even tipped my toe into that and written one. But ultimately, a lot of them, you can pay some of them as consultants, or some of them you just do it like literally they're happy to do it if it's an hour just for buying coffee. I had an issue about something I want to do, and I pinged a friend, and he had a friend. So it was a friend of a friend, and the guy was gracious, took about a 45-minute phone call with me. And, I had nothing, I couldn't even buy him coffee. This is COVID, right? So he's up in Seattle anyway, right? So, it was interesting. I used some terms, like DAOs, like I kind of casually mentioned, like, and he had no idea that like, you could do, like, he's like a lawyer, security person. He had no idea that in Wyoming, you could actually, has a special LLC for DAOs, right? So I sent him a whole bunch of stuff on that, right? Like I felt like I at least gave him, like I taught him something. He taught me a ton, and I taught him a little bit. I felt like I was trying to give back. Right. So if it could be as a two-way street, some mentors will do it perfectly for free. They're going to get some kind of benefit from them.
Awesome. Last question, Stephen, before we wrap up, and I'll kind of maybe put this into 2 in 1. What is something that you want to share as a final message to the audience that I haven't maybe asked you so far in this interview? Like any final parting words of wisdom?
Yeah, I've mentored a lot at accelerators. So understand that my views come from my experience over a long period of time. And we talked a little bit about my experience. You can probably get the idea. But having been a successful entrepreneur before the gold rush that we're in right now and during, I was called on by a lot of friends who have built accelerators to mentor companies. I've worked with a lot of startups. And one question I would ask when I was getting a bad feeling or just a weird feeling is, do you feel like you were put on earth to solve this problem? Right. And if not, go do a startup, go do a different startup. Right. So if you're doing a startup that, is, you don't feel like you were put on earth to solve this problem, then you really shouldn't do it. So it doesn't mean you have to be a domain expert. It just be something you have to have the passion to do it, because it is hard. I mean, everyone tells you it's hard, but trust me, it is. Right? Like the Zuckerbergs and the Bill Gates, all those people make it look easy, right? But they're the outliers. They're the 0.1%, right? Like whatever it is, like that make it big, right? Like the other ones, it's hard, right? So have passion. So then at least you'll have fun along the way, right? And then maybe make a dent into the world, right? So I'm not necessarily saying go out and like do something like, that wouldn't work, like that the VCs don't want to do. Like, like I have passion about like, the New York Mets, the baseball team in the United States, right? Like I can't really do a startup for the New York Mets, right? But I have passion about other things, and I've dove into them. One of them was developer tools, right? With Telerik, right? So you have to really enjoy what you're doing. You don't necessarily even have to be you don't even have to be a domain expert, because you will become a domain expert really fast at a startup. So just have passion for the problem that you're solving.
Awesome. And I think since you've done it 5 times, it definitely you, you've come to this earth 5 times to solve something important. So thank you, Stephen. Awesome having you on our show and sharing your wealth of experience. Really appreciate it. And thank you to all of our listeners for tuning in, supporting the show, following us on LinkedIn as usual. And we'll be back with another episode soon. So, Stephen, awesome having you. Thank you again.
Thank you. Thank you for having me. Happy to chat.